Imagine a localized market event that predicts a 20 to 27% price collapse, doing so with a failure rate of just 2%. You don't need complex algorithms to spot it, just a specific pair of vertical spikes that telegraph an imminent, steep drop. This weekly chart displays exactly what that looks like. In the center, two massive upward price spikes tower over the surrounding data. Market technicians call this anomaly a pipe top. Look closely at the internal geometry of those twin peaks. They share a massive overlap in price, and the actual difference between their highest points is microscopic. It creates a rigid, upside-down V that dominates the landscape. But here is the critical rule. The pattern on the far left looks identical, but it is an illusion. A pipe top is completely invalid until the price decisively closes below the absolute lowest point of the entire formation. The left pattern never broke its base, so the price kept climbing. Acting before that downward confirmation is a guaranteed way to bleed capital. Identifying the shape is easy, but waiting for the structural breakdown requires discipline. A structure is only as strong as the ground it's built on. If you want to see the pipe top at its most lethal, you have to track it into its natural habitat, a macroeconomic bear market. This diagram compares how the pattern behaves under different conditions. In a bull market, you might see a 20% drop, but in a bear market, the break-even failure rate shrinks to 2%, and the average decline plunges 27% in just 54 days. The formation doesn't spontaneously generate a crash. It acts as a release valve, violently snapping the stock back in line with an already established downward momentum. You can find two tall spikes on plenty of charts, but without the right surrounding context, you are looking at a false lead. This chart shows a textbook failure. A prominent pipe top forms here, but it is trapped inside the converging horizontal lines of a year-long symmetrical triangle. Notice the flat, sideways trading leading up to it. There is no steep upward climb to reverse. The downward potential energy simply isn't there, meaning short sellers who bought into the shape got trapped when the price eventually surged higher. This schematic illustrates the ultimate statistical profile. You want exceptionally tall pipes. You want the left spike to sit slightly lower than the right spike, and you want this entire formation to appear near the bottom of a stock's yearly trading range. Geometry gets you to the starting line. Reading the surrounding environment is what actually gets you paid. Once the trap is set, you need a precise exit strategy. This is the measure rule. You calculate the exact height of the pipe, from peak to base, and project that same distance downward from the breakout point to find your profit target. Let's apply this to a real-world scenario from the mid-90s steel industry, a sector squeezed by falling commodity prices and heavy political pressure. This chart of Allegheny Ludlam maps a pristine setup. Following a massive upward surge, the stock retraced, then climbed 36% straight into a towering pipe top at the crest. The execution is strictly mechanical. The moment the price closed below the pipe's base at $22.25, the short was triggered. To cap the risk, a rigid stop-loss went in at $23.25, just pennies above the right peak. 5 weeks later, the gravity of the steel market took over. The stock plunged cleanly to the pre-calculated target of $19, capturing the exact measured move. Keep this checklist next to your screen. Weekly chart, massive overlap, confirmed breakdown below the base, and an existing downtrend. A pipe top identifies the specific coordinates where an existing trend is prepared to resume its descent with